Welcome back to the channel and welcome back to History in the Making again here today in 2022. We had a very positive CPI report, the biggest beat to expectations in all of 2022. On the month over month, that was almost in deflationary territory. The year over year reading was much better than expectations. You couldn't have asked for a better CPI report within reasonable expectations. A matter of fact, this CPI print that we got was only a 15% probability by JP Morgan, and they estimated that the stock market would rally 4 to 5% off of a 7.1% reading. Less than a 15% chance. Well, it actually happened, and you did rally about 4% in the NASDAQ, and you rallied about 3.5% at the peak for the S&P 500. But how today played out is not very comforting for the bulls out there. We literally closed at the same prices that we were at before the CPI report came out. So you gave all of the gap up, this gap up from the CPI initial release, you gave that all away throughout the trading day today. And there's a lot of reasons for this, right? Let's not be blind here. There's a lot of reasons to be selling off on a good CPI report. The biggest one of which is valuation concerns. As we get closer to actually starting 2023, these estimates are coming in and they are super low. So if these estimates that we're getting are correct, you're still much too high on the S&P 500. And that is a big problem. At the same time, tomorrow we get the summary of economic projections in which that will say where every individual Fed member thinks interest rates will go and when they will eventually be cut. So markets right now are pricing in rate cuts by the second half of 2023. On one hand, rate cuts are negative. That's the most negative thing you could get, because why would the Fed be cutting rates after the inflation that we just seen? So on one hand, the Fed cutting rates a lot sooner could be bearish and would be very bearish. Also, at the same time, if the Fed keeps interest rates at 5% throughout 2023, that's also bearish. So it's like, where do you win in this equation? And it's becoming very hard to see this soft landing prospect, at least in the stock market, because there's just no good that could possibly come out of any of this, guys. So we're going to get into everything you need to know about the report coming tomorrow with the Fed, and this is going to be the biggest report and really data from now until the end of the year and even into January, until we start to get a lot of company earnings coming out. This is going to be the bread and butter, the meat and bones of why the market is going to either rip to the upside or potentially get close to those new lows even by the end of the year, guys. So let's get straight into it. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section if you have not already. And before we get into all of the data behind AMC, everything we want to know as investors in this short squeeze trade, I do just want to talk about the biggest thing for tomorrow. And I think one of the biggest positive things, at least hopefully you guys are positive about, this is not going to be a pre-market move, right? You're not going to see a big move in the pre-markets unless something happens that is not related to anything we're talking about in this video, a kind of black swan event, which how could you predict that, right? The markets are probably going to be pretty flat tomorrow heading into Fed Jerome Powell at 2 p.m. So you guys can have fresh positioning for this. And historically speaking, throughout 2022, they have tended to be pretty red days. And I think the Fed is going to fight back hard on this notion of the Fed pivot or that inflation has actually peaked. I don't think he's going to come out and say inflation has peaked. I don't think he's going to acknowledge a Fed pivot at all or the Fed cutting rates. I just don't see that happening. Now, if you look at the actual bond yields, the bond yields have fallen sharply, and that on this chart, which this is TLT, ticker TLT, when bond yields drop, this chart is actually rising. So this chart has been rising very steadily, and even today bonds rallied 1.22% and stocks were hardly break even for a lot of the day today. Once you're really down in the gutter, stocks were fighting to stay in green territory after this very bullish news, but bonds had no trouble, staying over 1%, right? So the bonds, relatively speaking, massively outperformed the stock market, especially when the sell-off started in the market. So from the Fed's perspective, you've already seen a 50 basis point or a 75 basis point rate cut determined by the bond yields. And that's what really controls lending, is the bond yields. The Fed tries to impact those by duration wise, by like the 2-year bond. If markets think the Fed's going to keep rates high for 2 years, those bond yields will probably stay higher. But ultimately, you have seen some big degree of loosening over the past month or two now, and the Fed does not want to be loosening right now. So I think the Fed's going to try to hawk down on this notion that maybe, we can get somewhat of a soft landing and that rates have to stay higher for longer, and that's one thing the markets are just not pricing in right now. The dollar did continue its drop, down about 1% on the day, which is fundamentally a good thing for businesses. Now, let's dive into AMC, because AMC was down about 5.5% after a pre-market move that wanted to take us very high. The stock was up over 7% in pre-market, and it looked very good until the open of the day, until the cash open of the indexes. And then AMC did what virtually every other risk-on stock started to do. They started to sell off with a little bit of a rally towards the end of the day, but it was pretty bad at one point for AMC. We almost touched the 50-day moving average and then just got toppled on, guys. And I think this is very indicative of how sensitive these stocks are to broad market moves. And that's why I like to acknowledge the broad markets here in these videos, because what happens affects AMC. It can be the difference between, a 7% positive day, or like we see right here, a 3.87% negative day, which relatively speaking is not a bad day whatsoever. Now, tomorrow with Fed Jerome Powell, I do expect to see a bigger move than we've seen today to the upside or the downside. And I think if Powell is just very bullish, I think the end of the day, Wednesday, you could see maybe an AMC up 5 to 10%. The next day could also be very bullish, or it could be very bearish. I am leaning towards bearish, but anything can happen. We have certainly been wrong in 2022, so has everyone else. Now, we did get a bullish indicator here called a hammer, and essentially it's these downtrending level of support and resistance levels over the past week, bottoming out, seeing a lower wick candle, and then seeing a higher high after that. That is what the hammer is, and that is seen as a bullish indicator, but we'll have to wait and see what happens tomorrow with the Fed, because that is certainly going to be the most important thing. Volume, about 35 million on the day. Nothing too crazy, nothing to write home about, guys. Now, let's get into some of the data that you guys want to know with the Ortex. Now, we'll have to refresh this page because it likes to just log you out if you haven't been on in like half an hour. So let's go ahead and go back to AMC and take a look at the option activity first. That's the first thing I want to look at. And it was a big day for options. 55 orders totaling $20.6 million. Positive order value of 6%. So not very positive, but there was a lot of money that flown into AMC options today, and I think that's a big reason why the stock was down as well. When there's so many put options going in on AMC, it doesn't matter if there's more buyers than sellers on that given day. It's still very, very hard to see a rally when you do have that constant, delta hedging by the market makers that are hedging out all of these puts that are coming onto the option chain. And at that, hedge funds tend to use, puts and option strikes, I should say, that are deep in the money anyways, so it doesn't take a lot for that break even to force market makers to start hedging out their positions. Now, if we take a look at the cost to borrow rate, sitting at about 20% for the day, cost to borrow average at 22.16%, cost to borrow max at 28%, and cost to borrow minimum at 6.5%. Now, do not get faked out by this next number. It is the live short interest of free float. I don't think this is correct at all. I don't think it's Ortex's fault that they're estimating this is so low, but I don't think it is correct at all, guys. Just based off of the charts, what we seen November 30th, the short interest was sitting at about 19.5%. Basically, all you've done is sell off since November 30th. So I do think the short interest is well over that 20% mark. But even here on the day, Ortex is estimating the short interest went up by about 3%. And the amount of shares that is sold short today went up by about 3 million. So it's saying the live short interest of free float is almost at 19%. I don't think mathematically this is even possible, and I do think any bullish reaction in the markets will be met with a much higher AMC share price, and I think that's the simplest way to put it. Days to cover sitting at 6.08, so it is still hard for shorts to get out of those short positions, guys. So let me know your comments, questions, concerns about today, about AMC, down below in the comment section. In the meantime as well, hit that like button and subscribe to the channel, baby. Thank you for watching, and I will see you in the next one.